Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Aaron back with us in the studios. Hey, Aaron.
Hey, John.
You're rested now. You're ready to go.
Yes, I had a little 2-week rest.
Well, that was cool. Play some golf and.
I didn't.
No.
I didn't play any golf. No.
Wow.
I'm going to do that next month.
Oh, you went.
Take another little trip.
You went south and didn't even take your clubs?
I have clubs at my little place down there, and I just didn't get them out. I had a lot of meetings. I had a few meetings with clients in Florida. Isn't that rough?
Yeah.
Go down there to work.
Mm-hmm.
And then I did some traveling, met some friends or saw some friends. And it's funny, I go down there. I see them up here all the time and go down, hey, can we meet? Because I want to see them in that world,
Sure.
right? In the Florida lifestyle.
So is that part of the initial interview? You ask them, when are you going to retire and go to Florida?
That's
So
right.
I
I
can go down
promote Florida
there.
all the time. And now I'm trying to get them in one spot.
So you don't have to travel around.
I have several that I see in the Villages area.
Oh, okay.
And not just in the Villages, which
Right.
is, north of Tampa near Ocala, but also around that area. There's 3 or 4 that live right there. So I think there's about 7 right there. And my little place is right near Ocala. So I got probably 40 minutes to several clients that live right there. And I didn't plan that. It's just how it's happened.
Well, I'm just really so proud of you that you stepped up and worked so hard through all of this, and you got your clients all situated. So that's what he does, everybody.
That's right.
What he does.
I'll take partial credit for that.
Okay,
Thank you.
absolutely.
Well,
All right.
one reason why I take credit for that, because we talk about these taxes, right?
Yeah, I was going to say, what are we doing today?
We try to minimize our tax bill, and we can use that money to buy something in Florida, maybe
Okay.
over time. So let's for the next few weeks, we'll talk about on the show taxes, because we're in that tax season. I seem to have been doing that over the last few years. This year, or this conversation, we'll be talking about the 2020 tax rules, some changes, minor changes, but the tax rules changed in 19, so they were passed in 18, and then now into 19 we had our first tax return that we did, and I'm saying that wrong. The tax laws were changed in 17, so 18 was the first year we filed, and this is the second year we filed under the new tax rules. So that's happening right now. First thing is, as a reminder, the standard deduction and personal exemption change. So no more personal exemptions. That was that $4,000, I think it was $4,050 that each individual got. So we got a family of 4, each child and each parent got $4,050. And then you got a standard deduction, which was $12,600, $700, $800, somewhere around there. That is changed. That's one of the biggest changes in the tax code. So now no more personal exemptions. And then they increase the standard deduction to this year, 2020, is $24,800 for a married couple filing joint. So a single is $12,400, or just half that. Head of household is $18,650. And if you are blind or over 65, you receive an additional, and I believe it's 65 and older, you receive an additional $1,300 if you're married, and $1,650 if you're a single person. So that married filing joint, $24,800, you could add in, if 2 people, right, you married, 2 people filing joint, you add in 1,300 times 2, that's 2,600 to that number. That's a pretty good, healthy standard deduction. So all income up to that number is no tax, 0 tax. So keep that in mind, because the next thing I want to talk about is what the brackets are and where you might fall in those brackets. When I talk to people, or I review the returns every year, which is something I do for all my clients. I want them to bring their tax return in. It's something I need to know, what tax bracket they're in for planning purposes, especially for retirement income purposes. We want to know what brackets they're in. And then what I do is just this sheet that we're looking at right now, John, that I'm referring to, I break this out, put it in front of them, look at their tax return, and then show them where their brackets are. I want them to focus on how much tax they're paying and why they're paying that tax because of, this deductions and these brackets and what the percentage is of tax that they're paying. And then ultimately, what's the effective rate that they're paying, right? Because we have like this progressive tax system, that we start at a lower number, and then the more income you have, that percentage goes up. So we have like this blended rate or effective tax rate. So that's what I want people to focus on, because if you do that, then you can make good, solid decisions about where you're going to take income, why you're going to take it from a certain place. But also, if you're thinking about working part-time or taking an extra job, or you're investing in a particular investment that might pay you dividends or capital gains, you want to know where you fall into those tax brackets. Or you are not retired and you're making contributions to your retirement plan. And me as an advisor saying, to me, it's a no-brainer when you're in that higher tax bracket to take your money or your extra money and put it into your retirement plan rather than anywhere else because of that high tax rate that you're paying. And again, you are keeping it for yourself, you're deferring it, and it can make a big difference in later years. But I always just try to tell people, don't think like, I like going to this tax person because he gets me a big refund. Well, what's a big refund, right? Is it, a $1,000 refund to a person may be a big refund, or a $5,000 refund to another person. That's a big refund. Don't focus on that part of it. Focus on that rate or effective rate of what you're paying in tax and how you maybe can control that or reduce your taxes. So, married filing joint. Remember I said what the standard deduction is, and let's just say it's $24,800 for the married filing joint. You pay no income tax up to that number. We're just talking federal, not state, capital gains, none of that, just federal taxes. The next $19,750 of income, your rate is 10%. Up to $80,250, the rate is 12%. So if you're doing just general or simple math, and you say, if I'm married and I make $80,250 a year, I'm going to take off that $24,800, subtract that, and you can see I'm going to have the first $19,750 in the 10% bracket, and the rest of that's going to be in the 12% bracket. Or you can look at it, and this is what I talk to clients about, especially the working clients, because usually they're the ones with the higher income. If I have an $80,250 net tax bracket of 12%, the next bracket is 22%. So if I can keep all my income at 12% or less, that's the least amount of tax I'm going to pay, at least federal tax. So by adding your $24,800 standard deduction to that $80,000, you're sitting somewhere around that $105,000 number to round things off. I can make, or you can think this way, $105,000 as a married couple and still be in the 12% bracket. Every dollar over that, I will be in the 22% bracket. So when you're looking at your tax return, or you're looking at your, gross wage, on your biweekly statement or however you get paid, that will show you, or you'll know from that what your gross wage is, because all those numbers are right there. I'm not talking about what's going in your bank account. I'm talking about what that gross wage is. So then you may be contributing to your 401k. So if you're at that $105,000 number and you're contributing to your 401k, you're deferring 12% federal tax. And just to throw in there, state tax in Michigan is 4.25% flat tax. So you know you're deferring 16.25%. Those are the things you need to think about and feel good about it too, because I give the example of, let's go to that next tax bracket of 22%. So somebody has $125,000 of income gross, and so they're $20,000 over. So I talk to them about, this is what you're doing if you're not contributing to a retirement plan. You got $100 that you contribute, right? That $100 is 100% going into your contribution, into your 401k. If you're not contributing, that $100 is taxed at 22% federal and 4.25% state. Let's round it off to 25%. So that's $25 for every $100 that you're making, and you keep it and going into your savings or checking account. Remember, it's only $75 going in because you're giving $25 to the tax man. So why not really work hard and think about, how can I defer as much as I can to get closer, right, to that 12% bracket? So these are discussions I have often with especially working people, and try to show them, here are your options of deferral, and this is why you want to defer as much as you can.
And so, between the 12 and the 22, if you put it into your 401k, you're making 10% right off the top, then plus whatever you would make because it's invested and not sitting in your bank account.
That's right. You can certainly look at it like it's already an increase, in rate of return immediately. And even if you just do a bank CD, look what you're doing, right? Even if you're getting 1 or 2% at the bank, in an IRA, I'm talking about an IRA CD, which you certainly can do, and I have clients do it. Look what you're doing to just defer those taxes and keep it for yourself. It's yours. Now, I use that word defer because I have some people say, why do you keep saying defer, defer? Well, defer means you're just deferring the tax, because when you take that money out, which will come out someday, whether you're alive or not alive, somebody's going to have to take that money out. The government forces it on you. When you take it out, then you're going to have to put it on your tax return, all of it, because all of it's taxable. We call it pre-tax, deferred. When you put that stuff on your tax return, you're going to have to pay whatever bracket that you're in. Well, most commonly when we're working, we're making the most income, and we might be in that 22% bracket, or maybe even the 24% federal bracket. But when we retire, our income reduces. At least a lot of it may not be taxable, like Social Security. If it's not taxable, then it reduces our total income, and then maybe we're in the 12% bracket. So think of this. You deferred at 22%, and you're taking it out at 12.
And maybe you have more control when you're taking it out than when it's going in.
That's very true. Very true. I look at, especially for young people, and I say young people, I'm 53, so it's younger than me now. Those that, you might not think about it, 20s and 30s, but you're going to make more money than you are later than you are today. So when you get to that point, and there is some type of breaking point where you start thinking about it at 45, maybe it's as late as 50. If you haven't saved, you really need to think about it. Now, if you're a parent and a grandparent that's over those numbers and your kids are not, you think your kids are not doing that or getting the job done, get them in to see an advisor and get them to talk to somebody, because if they haven't done it by now, they're probably not listening to you. That's just how it works. Yeah. And it happens, right? And I think about this, sometimes even financial advisors, we have an issue with taking care of our own, right, within our own family. And that's just how it is. A mechanic, goes to work every day and works on everybody else's cars. The last thing he wants to do, go home and, wrench on his own car. So hopefully he takes it to work and, fits it in, right? But that's just how it is. Sometimes we let things go within our own family. So I love seeing young people. I've had 2 young people. When I say young, I mean in their 20s that have come in and talked to me. I don't charge for that. I just really admire people. And half of them are already got their ducks in a row, right? They're already doing what they need to do. They just need somebody to give them some reassurance and maybe tweak things a little bit. Then there's others that, parents or grandparents see that they're struggling. They maybe make some decent money and they feel like they need a little adjustment. I didn't say attitude, but they just need a little adjustment. So Sometimes it's good to have somebody on the outside. If I take I'll go back to the mechanic. If I take my car to the mechanic, I'm listening to that person. They're the expert in that world. And I rely on them to, just take care of business. And that's what I do. I just try to take care of business for you.
So how can people get their business taken care of?
Give me a call, 265-3540.
All right. Thanks a lot, Aaron.
Thanks, John.
That's Money Talk with Aaron Ricketts, presented by Ricketts Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.